Peter Rose, Longwood Currency Trading. It's ended December 2021, getting ready to go into the new year. And I thought I'd cap off this year with an error I found in my own trading, and it has to do with the topic of this video, which is how to pace your Forex trading. Pacing your Forex trading should be an integral element of your trading plan. And by pacing, what I'm referring to is the frequency of your trading as a function of your desired average win value, as well as your yearly profit target that you're shooting for. So you're trying to figure out how you should pace your trading, which is how many times you're going to need to trade in order to achieve your yearly profit target, and it's going to be a function of what your average win value should be. So I'm going to break all that stuff down and chat a little bit about each one to you as we go. So pacing is like you would watch if you watch a horse race, how the jockey paces the horse for the distance that they need to go, or a long distance runner paces the initial part of their marathon that they're going to run in order to have the stamina and the wherewithal in order to throw it in full gear as you get to the end of the race, and you really need that extra energy to go. Pacing is such a critical aspect of so many things that we do in our lives, our jobs, how we look at our salary and all the other stuff, that there's certainly a factor of that pacing that we need to think about in our own trading. And I'm afraid that I'm a failure at that particular aspect and not recognizing it as it should be. In fact, I'm in a seriously underwater position right now because of a pacing issue. I'm just going to let it run out to the end of the year, and it could be a catastrophic loss for me, or it could turn around and I won't take such a bad loss, or maybe I'll even make $20. Who knows? But it's a big position, and it's totally wrong because I paced it wrong. In my particular issue, what I've recognized over the past year of trading, and I've done fairly well. I took some fairly good hits at the beginning and had to make those up as I went along, and got scaled up my account size that I was actually trading after going through the previous year where I had taken a really, really severe hit. So the pacing has to do with, well, as I explained, it has to do with the frequency of your trading, and that's got to be some function of some stuff. But what does that frequency of trading mean? What does that really imply? And it implies, and again, I'm going to address this as a day trader because that's what I am. I think the pacing for a long position trader, someone who's going to be in positions characteristically for weeks at a time, or at least days at a time, their thought of pacing is not, they have no control over the pacing. You put a trade on, and then you wait. In day trading, your capability is, if I'm trading on the 5-minute chart, which I do, I have 12 trade decisions an hour to make, because 5-minute candles, right? So now those could be entry decisions, they could be exit decisions, they could be I just want to be flat at the end of the day. That may not really make any difference, but I have 12 of those decisions an hour. So the decision that I have to make as I look at my overall trading plan for the day is how many times am I going to have to trade? Part of that is a function of my personality, right? I'm not well suited to long-term trading, And when I get into long-term trading, I tend to hold those losers way, 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 way longer than they should be, because it's just not my personality. I'm far better off as a day trader, and when the thing goes against me, which most of the time the price does go against you, you just got to cut it and go. I could have taken that short loss 6 times and still not have lost as much money as I'm currently losing right now. So as a day trader, it's not a complication. I mean, a long-term trader would look at it as a complication. I look at the pacing as an advantage, and now that I've gone through this past year where the pacing has become sort of an underlying theme as I've gone through the trading, sort of in the back of my head, not really recognizing that it was there until the last month or so, or 2 months of trading, where I've gone back and reevaluated a lot of the trades that I've made. You know, where did I go wrong? Where did I go right? When I went wrong, or even when I went right, was I being paid for the time, for the period of time that I was holding the trade, for the risk that I was taking? So, as a quick example, I go in. So maybe I go in a scout mode with 3 lots, and I pick up three pips. That's $90. It starts to chatter. I pull it, and so I make my $90. Let's say I do that same trade, 3 lots, and it goes up 3 pips, and I think, oh, I'm going to hold on to this, and I hold it and hold it and hold it. It goes up to 20 pips or 15 pips, and I'm still holding it, and I've got my stop that's moving as I go, and then it slides back down, and I don't know, there's all these crap and things, and then I just get out. And I get out with 8 pip win, let's say. So I've got 240 on the deck. Now, for the scalp method that I just did, making 3 pips in basically 30 seconds. So I make 90 bucks in 30 seconds. Let's call it a minute. I make 90 bucks in a minute. I do that 4 times during the day. I've got a pretty sizable amount there. But this other trade that I held for longer, and then came back so that I made X amount of dollars. If I take that time frame and I multiply that number of dollars by the time frame that I have to trade, you can't trade all day, you get a 2-hour period or 4-hour period, whatever you're going to trade. Did I get paid a sufficient amount of money, the $90, for the length of time that I held the trade? I made the 90 bucks, so that's a good thing. But time has a factor on it. You know, if they say we're going to pay you for X amount of work, and here's the job, like a contractor working the house, and he comes in and he goes, I think I can do this in a week. Okay, I'll give you $4,000 to do this in a week. That includes the material cost and all the rest of the stuff. But it takes him 20 weeks, and he makes the $4,000. He hasn't been paid for the time that it took him to do that. Now, granted, a skillful contractor isn't going to make a 5-time error on their pricing estimate or their work time estimate. In trading, it's not quite that simple. Sometimes you're going to let that price run, hoping that it pays more to compensate for the time that you have the trade on. So you have to look in terms of if I'm going to be a day trader, then how many times in my trading window, let's say I got to trade for a couple hours in the morning, and then I'm off to work. And you can't trade during the day, and the pair that you like doesn't trade after noon or something, like some of the European pairs in relationship to the dollar, for example. You know, most of those are not going to be trading at 8 o'clock at night with enough volatility where it becomes viable for you to trade perhaps that pair. So you've got that 2-hour window at the beginning of the day. You get up at 5 o'clock and then you're out the door at 7 to get to work. So you've got that 2-hour time period in order to do your trades. So how many times are you going to have to trade during that 2-hour period of time to make your average win rate per trade to give you, multiplied by the number of days that you trade over the course of a year, will that achieve your yearly profit target? Let's say you want to make $30,000 a year on your bank. And so $30,000 a year divided by the number of days divided by the number of hours, it comes out to you need to make this amount per hour. So if your average win rate is 20 bucks a trade or 30 bucks a trade, how many times am I going to have to trade per day to equal that that hourly value that you need to hit? See, that's what I'm talking about as far as the pacing. But what's going to happen is that if you don't understand that balance, then you're either going to trade too little and not be able to achieve your goal, and then as you get close to the year, you start pushing it, and that's where you're going to make some errors. Or you push it right up front, and you say, I'm only going to be here for 2 hours, and I'm looking for this special setup, and it might come in 1 hour, and so my profit target is X pips, and I'm going to have to do that trade 5 times in order to make my my win rate, average win rate, multiplied by the number of times that I trade and win equal to that value in that 2-hour period of time. So, that's something that you can't write down in a book and say, oh, this is how you do it. I'm going to do a blog post to this. I don't know whether I'm going to get it done in time to get this video out, but you might want to check the Longwood Currency Trading site for a blog post of this same title, How to Pace Your Forex Trading, because I'll work out some of the equations there as to how you would kind of calculate this stuff and figure it out. A little hard to do on a video, and I stand at a whiteboard and go through this stuff. I mean, that's just, God. It's the principle of the pacing that I'm trying to get across to you. And that pacing needs to be determined, or the pacing is the frequency of your trading as a function of your desired average win value. In other words, maybe not so much the desired value, but whatever your, over a long statistical sampling of trades, what your average win rate is on a per trade basis, not on a when I win, this is average what I win. It's a per trade win value. I've talked a lot about the difference in that in many of the videos and a lot of the blog posts that I've done. And I cover that pretty much in depth in some of the courses that I've done too. Anyway, it's the pacing is the frequency of your trading as a function of your average win value, per trade win value, and your yearly profit target. So whatever that profit target is, that's a variable, and your average win per trade win rate is another variable. And so you're trying to match up the frequency, the number of times you're going to have to trade, and you're going to have to balance these other two numbers so that they mesh up with what your ability is. If you don't have the ability to make a 20 pip average trade win, you're going to have a hard time meeting that $30,000 goal, right? So maybe you ought to drop that to $10,000. So what you can do is you have three variables in this equation, and then you just go through and you experiment with the value of each one to see what each one reasonably should be. And of course, this is called metric analysis, trading metric analysis. Well, if you don't have any metrics when you're trading, you're kind of shit out of luck. So this is not a beginner topic. This is for an advanced trader that has, and I always say, a 300 sample size of trades, because the first 100 that you do, they don't count because you don't know what the hell you're doing. And probably the second 100 don't count either, because when you finally figure out what you're doing, you're still not going to be consistent, but at least you have your process down. And then the other 100 trades, you develop a consistency in your trading, and so that the final 100 of that 300 sample size, that's really the one that you're going to have to go by, because that will be consistent trading, and it will give you the metrics, and one of those metrics is the average trade win value that you're going to need. It'll give you valid metrics in that, and so you need time in order to develop those statistics. You can't just sit there and sip your coffee and say, "Oh, I hope to make 10 pips. When I win, I'm going to win 20 pips, and on average over my winners and losers, it's going to equal out to 10 pips." And so I'm in good shape because I trade 5 days a week. I make 50 pips a week, and I trade one lot, so I'm making $500 a week. Okay, great. Yeah, I don't know. You're going to have some solid data if you're going to plug into these equations. So check out that blog post when I finally get it up there, and see if that doesn't make any sense to you. Throw me an email, and I'll see if I can help you out briefly. If not, work something else out to try to help you out. If you are a beginner or someone with less than a couple of years of trading, or you've got less than 300 trades under your belt, and again, this is for short-term trading. I mean, if you're a long-term trader, most of what I say is gibberish, because it's going to take you years to get 300 trades. That's your problem, not mine. I can't help you. There's a different set of mathematics that you have to use for those longer-term trading metrics than you do on the shorter-term trading, and it's a hell of a lot easier on the shorter-term trading to do that. So, in any event, if you are under that, or you're just getting started trading with less than a year or two of experience, don't try to figure out what your pacing is, because you really don't have the data for that. Just be aware of the fact that as you're trading, try to be consistent in the number of trades that you do on a daily basis. If you're doing 2 trades a day, and then you get into a situation where you find yourself doing 10 and then dropping back and you're doing 5 and then you're doing 1, you got to be really, really careful, because that's where I got screwed up this year. I did really, really well, and then I screwed up really badly, and I couldn't figure out, I know where my weaknesses are in the trading, but in going back now over the entire course of the year, the root of I understand what I'm doing wrong, but I didn't understand what the root of that was. And that's why I couldn't efficiently or effectively address the problems that I was having, because I didn't understand what the root of that problem was. And it's this pacing issue. And now that probably will not be an issue for you. Remember, I come out of a 40-year experience as a real estate investor. And pacing is a critical issue there, and it's done totally differently, but I've got a lot of really, really good, solid financial money management habits from 40 years of real estate investment, dealing with hundreds and hundreds of thousands of dollars. A lot of that good stuff is not directly applicable in the currency market trading, not even in the long-term trading. It's just not applicable. Well, it's applicable, but the timing is different for it. And that's where I think I've been screwed up. I mean, it's like like a dog, you know, you raise your hand like that. The dog goes like this. It knows what's coming. And so when I look at the currency trading in relationship to the real estate, in the real estate, this kind of, oh crap, and your response to dealing with that is totally differently than what needs to happen in the currency market. It's not black magic, it's pretty easy to figure out. If you have somebody to point that out to you, which I never did. I've had to learn this stuff on my own, and so I'm getting into the swing of the thing. I know what I'm doing, I know what I should do, but I did miss this pacing issue. I was sort of implementing it, but sort of doesn't cut shit in the currency market. You got to get it right. If you don't have everything right, and you got to make sure all these things that are right are just simple things. And I didn't make it simple because I'm used to solving complex problems. I'm used to solving real estate investment issues. I was a software engineer for 33 years. This is a very complex environment. So it's almost impossible for me to look at something and not, well, this is a complex system and I got to figure out how to do it. Everything is complex. Jesus. This thing here, this friggin' timer, you have to really, really read the instruction manual in order to understand which buttons to push and when and how to clear the thing and all that other kind of crap. Engineered, way over engineered. That you have to figure that stuff out. And if we don't use it for a couple of weeks, because we're older, and we'll forget, and then you come back and the instructions are gone, that fucker's going into trash. That's what I'm going to do. When I first started with it, my wife brought it home, and I started to do it, and I got pissed off. I almost threw it against the wall. This is over-engineered and stupid. It's complicated. Everything is complicated, but not the currency market. That's simple. It's not easy. It is difficult, but you can make it simple. And pacing is a really simple thing to do. It's just that you have to recognize what it is and where to insert it into your trading plan. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.